Excellent. So let's go ahead and get started. Well, good morning, everyone, and thank you for joining. We appreciate your participation and welcome you to the webinar, Proposed Tax Reform for Mexico 2021. It is my pleasure to introduce Victor Ramos, our tax director, with over 13 years of experience in providing tax advice matters, and Renata Aguilar, our tax manager, with 10 years of experience in international tax. Okay, I would like to share with everyone how the process is taking shape to start with the proposed tax reform. So, what is happening right now? Our president submitted to the Congress the economic proposal for 2021. Compared to 2020 economic package, the proposal addresses more administrative and enforcement type of tax issues, with fewer cross-border tax implications, and does not include tax increases or new taxes. Before the proposal can become law, both chambers of Mexico's Congress must debate on it. They need to approve the proposal by October 31st. Once approved, the proposal will be sent to the president for his signature and will be published in the official Gazette. The proposal will become law on the date of publication and should be effective on January 1st, 2021. Taxpayers and investors should be aware of these proposals as they make their way through the governmental process. Nice tip there. So with this being said, now I would like to add Victor, since he will be sharing how this has impact during this pandemic. Go ahead, Victor.
Thanks, Alejandra. That's very interesting. So as stated in the media, the proposed economic package is consistent with President Obrador's commitment on not raising taxes during his first 2 years in office. The proposed 2021 tax law also clarifies and amplifies the value-added tax treatment of digital services, which has been continuously discussed during the last year. To have a better understanding of the current situation from a Mexican tax perspective, we need to consider the outbreak of COVID-19, which, as you all may know, is resulting in a health crisis and a drop in economic activity without precedent in recent history. So let's say, with this being said, as you may imagine, under the current context, the proposed tax law changes are focused on tax collection by enacting broader recharacterization and tax assessment powers by mainly continuing incorporating fundamentals of the OECD base erosion and profit shifting initiative.
Excellent. Thank you, Victor. Thank you for sharing that. So before we start, I would like to say, please feel free to send your questions. And at the end of the session, we would be happy to answer them in the Q&A. So let's go ahead and talk about the agenda. And the first thing that we would be talking about is the general criteria of the economic policy. Second, revenue law. 3, value-added tax law. Number 4, income tax law and federal tax code. So let's go ahead and jump into the first item here, and I would pass over the micro to Victor. Go ahead and let's talk about general criteria of economic policy.
Thanks, Alejandra. So let's first talk about the general economic policy criteria for 2021, which establishes or is established based on the difference compared to previous years, and is determined based on an analysis of economic, social, health, and also public finance aspects in Mexico. The general economic policy criteria for the bill for the federal revenue law and the federal expenditure budget establishes the macroeconomic projections, as we may see in this table. So all these macroeconomic impacts are being shown in the revenue law for 2021, which, as we can see in this table, assume a GDP decrease of around 8% and an increase in tax collection without the creation of new taxes. Great.
Alrighty. Go ahead, Victor.
Yeah,
I thought we were on the
sorry,
next one.
Alejandra. So this is the collection estimation. So probably this may serve you as a reference as income tax continues being the tax that it's major represented for the tax government. So please move to the next slide, Renata. So regarding interest withholding by financial institution, it is proposed that financial institution withhold individuals an income tax rate of 0.97% instead of 1.45, which was the rate applicable during 2020, and is applicable to the principal that generates interest payments. Please bear in mind that this rate considers the expected inflation during the period. So whenever the inflation is expected to increase, the rate decreases as a consequence. It is also important to mention that the surcharge rates for extension on payments of tax liabilities will remain practically the same as in 2020. So regarding tax incentives in Mexico, we can say that most of the tax incentives are included in the revenues law. So in principle, the 2021 revenues law keeps the tax incentives granted to date, except for certain tax incentives that shall be considered by the beneficiaries as taxable profit for income tax purposes upon their application.
Excellent. Thank you, Victor, for sharing this valuable information. Now let's go ahead and move on to another very interesting topic here. Value-added tax law. Go ahead, Renata. Let's go ahead and jump into detail with that, please.
Thank you, Ali. Thanks for the introduction. Okay, so what I was saying is that regarding the VAT law, the amendments to the digital economy rules proceed in position of penalties for both digital service providers and the concessionaries of the public telecommunication network. Remember that as part of the Mexican tax reform 2020, it was required that non-residents providing digital services collect and remit the VAT on transactions with Mexican customers. Also, non-Mexican residents would not pay in Mexico that operate as intermediaries, connecting providers with buyers over the internet using their platforms, have the obligation to act as a withholding agent. So in the case of non-residents that provide digital services to recipients located in Mexico, their access to internet infrastructure could be temporarily blocked by the concession holders of the public telecommunication network if they fail to comply with any of the following obligations: obtain a Mexican tax ID, appoint a legal representative in the country, have a tax domicile in Mexico, or issue electronic invoices. Also, if they have complied with that, but they have not filed or they do not file their monthly VAT returns or the monthly informative VAT returns for 2 consecutive months or the quarterly informative VAT return for 2 consecutive periods, not only their access could be blocked, but also their tax ID could be shut down by the tax authorities. Of course, the proposal provides for a procedure to clarify the inconsistencies identified by the tax authorities before carrying out any of these measures. So regarding the obligations of digital platforms, the proposal expands the initial obligation of non-residents acting as intermediaries to withhold and remit VAT, not only on transactions where the seller or the service provider is a Mexican individual, but now also in those transactions where the seller or service provider is a non-resident. So this means that this non-resident rendering services through a digital platform will no longer have the obligation to obtain a Mexican tax ID, obtain a legal, appoint a legal representative, have a tax domicile in Mexico, or collect and remit VAT, always that the intermediary complies with the remittance of the tax on their behalf. Also, the intermediaries would have the option to publish on their website the price without expressly and separately indicating the applicable VAT, as long as the prices are labeled with the legend VAT included. Until now, intermediaries involved in the sale of used goods do not have to register, collect, and remit VAT, given that the sale of used goods is an exempt activity for VAT purposes. However, the proposal aims to eliminate such exemption and require intermediaries selling used goods to comply with all the VAT obligations. So moving on to another topic also of the VAT law, that would be the last modification. So it is proposed that to include the professional medical services provided through civil societies or private welfare institution as an exempt activity.
Well, before you go on to this income tax law, I mean, it was really interesting hearing about all this digital companies. So please, let's take care of these changes. And now let's talk a little bit about the income tax on this.
Thank you, Ali. So moving on to the Mexican income tax law, the modifications includes amendments to the applicable framework for nonprofit organizations. Specifically, the proposal aims to include provisions to prevent the misuse of nonprofit organizations for illegal activities, and also looks forward to limit certain aggressive schemes carried out on a recurring basis by such organizations. So with the following amendments, the purpose is to inhibit these abuses. So the first is that every entity that does not hold an authorization to receive tax-deductible donations would not be entitled to be registered under the nonprofit regime. And some of the reasons to lose this authorization would be the following. First, when more than 50% of their income derives from activities that differ from the purpose for which the institution was authorized to receive donations. Second, not issuing tax invoices or issuing them as donation when they actually cover transactions different from a donation. The third would be in the will be to be in the blacklist of taxpayers that carry out sham transactions, and the fourth, use their assets for purposes other than the social object for which the authorization was obtained. So if the authorization is lost, the entity should transfer all of its assets to another entity authorized to receive donation. Also, it was proposed the elimination of the certification concerning the fulfillment of the tax obligations, transparency, and social impact. It is proposed that the following entities must obtain an authorization to receive tax-deductible donations if they want to be registered under the nonprofit regime. So the first one would be the associations or company that grants scholarships, those engaged in scientific or technological research, entities engaged in the research and conservation of wildlife species and environmental protection activities, and entities engaged in protecting endangered species and habitat conservation. So now let's talk about maquiladoras. So the maquiladora regime rules will not change except from a minor wording modification to reinforce the original intent of the 2013 Mexican tax reform. So the change would reinforce that maquiladoras must apply either for the safe harbor methodology or secure and advance transfer pricing agreement, also known as APA, to satisfy transfer pricing rules. And that would be it regarding the Mexican income tax law.
Excellent. Well, thank you so much, Renata. Those topics are very interesting now that we know, well, there's a lot of companies digital, right? So let's go ahead and now talk about federal tax code. Let's go ahead and go into detail, Victor. Go ahead.
So, in my opinion, the most relevant amendments of the proposal are included in the Mexican federal tax code, as most of the changes seek to enhance the tax authorities' audit powers and to eliminate aggressive tax schemes implemented by taxpayers. Among others, as we will see in the next slides, the proposal includes new assumptions regarding joint and several liability regarding spin-offs and related parties of foreign residents with a permanent establishment in Mexico. Also, it includes amendments on the Mexican General Anti-Avoidance Rule, additional requirements for non-tax spin-offs, adjustments in favorable balances refund procedures, and also adjustments to procedures and attributions of the authorities in matter of verification and controversy, as well as in the procedures for requesting conclusive agreements. So as part, let's go back a couple of years ago. So as part of the tax reform enacted on December 2019, Mexico established a general anti-avoidance rule that allows the Mexican tax authorities to recharacterize a transaction for tax purposes if it lacks a business purpose. Probably you have heard about it. So also the last sentence of the general anti-avoidance rule states that no criminal consequences should result from the application of the general anti-avoidance rule. The proposal would clarify that this provision would not impede a criminal investigation or charges. So the bill also proposes amending Article 14 of the Federal Tax Code to specify that sales with deferred payments or installments will be considered as such when the entity issues a simplified tax receipt. So regarding spin-offs, for Mexican tax purposes, a spin-off is treated as a tax-free transfer of assets if certain requirements are met. In an effort to address a perceived abuse of tax-free spin-off, the proposal would treat a spin-off as a taxable transfer when the spin-off increases the stockholders' equity in any of the entities involved, leading to the creation of provisions or accounting entry that did not exist previously to the spin-off. In other words, the spin-off would be treated as a taxable transfer, even if all of the other requirements are met. Also, the proposal would establish that jointly liability may apply to a spin-off that is treated as taxable transfer. Jointly liability also apply when foreign related parties of Mexican resident companies have established a permanent establishment as a result of transactions conducted with the resident companies. On the other hand, the bill also seeks to consider as recognized market not only the Mexican stock exchange, but any other corporation that obtains the concession title granted by the Ministry of Finance. Thanks. Regarding the cancellation of digital stamp certificate, the bill proposes canceling the digital stamp of taxpayers that are issuers of tax receipts that have not disproven a presumed non-existent transaction or a presumed undue transfer of tax losses. I think that this point is very relevant because, as I mentioned in the introduction of this webinar, many companies are dealing with certain problems regarding cash flow. So with regards to refunds of favorable tax balances, the bill proposes that a refund request should be considered as not having been submitted when the taxpayer or the address provided by the taxpayer cannot be located in the federal taxpayer registry. In addition, in order to make the refund process more timely and efficient, it is intended to allow the tax authority to determine, in the event of several refund requests filed by the same taxpayer for the same type of tax, where it should perform a single tax audit for all the requests or separately for each request. And then, in either case, issue a single ruling. So this is very relevant for cash flow in your companies. Thanks. So regarding the use of technology, we can say that since the use of technology has become a fundamental element for the exercise of the authority's powers of review, the bill proposes using technical tools such as cameras, recorders, and mobile phones to record images or material that will serve as proof of the assets located in the taxpayer tax address.
Okay, so I'll continue talking about the proposed changes to the federal tax code. So regarding the visits, an adjustment is made with respect to the places where visits may be carried out to include offices, warehouse, or any place where administrative activities take place. And regarding the tax audit report, it is proposed that the CPA that has prepared the tax audit report. Besides providing the tax authorities the work papers required under a tax audit scenario, also appears before them to make any needed clarification. In the past, the Mexican court ruled on the matter, establishing that the CPA was only obliged to provide the evidence of his work, but not to be called by the authorities. Now that's about to change. Regarding audit related to foreign trade taxes, the CPA should also observe taxes and duties regarding these foreign trade transactions. I'm talking about the deadlines to fulfill tax authorities' requirements of information. The period to provide information to tax authorities in the case of difficult to obtain documents is extended from 6 to 10 days, which is a good thing. And also, it is proposed that the electronic reviews performed by the tax authorities must be concluded in a maximum period of 6 months, except concerning foreign trade, in which case it will not exceed of 2 years, but only in those cases where an international verification has been requested. Now, talking about the improper transmission of tax losses, I will go a little bit on deep on this because I think I consider that is an important amendment. Currently, our Article 69B of the Federal Tax Code establishes that when an authority detects that taxpayers has issued tax invoices without having the asset, staff, infrastructure, or material capacity to provide services or sell goods, or when the taxpayer is not located, the operations supported by those tax invoices will be considered as non-existent. And the modification aims to clarify that when taxpayers obtain tax losses by applying deductions that do not comply with tax requirements, regardless of the legal form, the tax authorities could require the taxpayers to provide information to demonstrate that the purpose of the transaction was not actually to obtain a tax benefit, but it was related to the business activity of the company. So if the taxpayer failed to correct the tax situation within the following 30 days after being required to clarify the purpose of the actions that have resulted in this transfer of tax losses, the tax authorities would have the right to conduct an audit. This without detriment of any penalty that might be applicable to the review. Also, please note that improper transfer of tax losses under the Article 69B bis of the Federal Tax Code is considered a simulated act, which is a punishable offense. Now let's talk about the conclusive agreement. So what is the conclusive agreement? This is a legal figure that raised as an answer to the many complaints that taxpayers have made during an audit, because the audits in Mexico may last from 12 to 24 months and represent several costs, financial and non-financial, for the taxpayer. So in this framework, la Procuraduría de la Defensa del Contribuyente, also known as PRODECON, designed a special procedure in order to offer better and definitive solutions for every audited taxpayers. So the PRODECON acts as intermediary between the taxpayer and the tax authorities, and even as a public witness in certain procedures. So this taxpayer ombudsman advocates for convenient resolutions not only for the taxpayer but also for the tax authority, because the objective is to build progressively a new relationship among the parties. However, the tax authorities have expressed that conclusive agreements are frequently used by taxpayers to delay and interfere with the access of authorities. So it was proposed to reduce the period to present a conclusive agreement and increase the reasons to deny its admissibility.
Just to give a quick update to the audience, please feel free to send us your questions through the chat so they can be answered in the Q&A session, okay? Right now, we'll be happy to read them so we can answer them later on, okay? Go ahead, Renata. Just a quick.
Thank you, Ali. Thank you. Okay, so now talking about transfer pricing penalties. So the possibility to reducing up to 50% of the transfer pricing penalties was eliminated. So only a 20% reduction would be granted by the tax authorities if the penalty is paid within the following 20-day period after the taxpayer is notified about the obligation to pay. So what the tax authorities said is that globally, transfer pricing penalties are much higher than normal tax compliance penalties. And also, the tax authorities propose as aggravating circumstances not to prepare the transfer pricing study, the local file, the master file, the country by country report, and not complying with Maquila obligations. So moving on, presumption of smuggling. So the proposal is to include as a presumption of the crime of smuggling, the omission to return, transfer, or change the custom regimes of goods, for example, merchandise or fixed assets, that were temporarily imported under Maquila or an export program, where the legal state of such goods in national territory relies on the validity of this program. Regarding the notifications, it is proposed to authorize the tax authorities functionaries to use technological tools to collect pictures or any other relevant information related to a taxpayer's physical address that could serve as evidence of the verification visit. Also, if the legal representative is not at the physical address, the visit could be conducted with anyone present at that time. And the last modification to this notification provisions is that regarding those notifications made through stamps at the tax authority's office, the period of time where the documents could be seen by the taxpayers or the general public would be reduced from 15 to 6 days. And this modification is just to speed the processes. And we have arrived to the last modification proposed to the federal tax code, and this is about how to warranty tax liabilities. So when the tax authorities order the seizure of companies' assets to warranty a tax liability, the proposal clarifies that such assets could only be tangible. So not trademarks, no brands or goodwill, like to guarantee a tax liability, because they are not considered as an ideal method to do that. Thank you.
Excellent, excellent. Well, thank you so much. Thank you so much, Renata and Victor, for sharing this valuable information. I hope everyone did learn a little bit about all these changes. Thank you. We will now continue with the Q&A session. Alrighty, let me look into the questions so we can get started. Okay, let's go ahead and start off with this one. Which should be the immediate takeaways as a consequence of the proposed tax reform?
Renata, I think I can take this one. So
Thank you.
That's a very good question, and I think it's the first question that you may ask yourselves whenever you hear about tax reform. So as we mentioned during this webinar, the proposed tax reform is focused toward strengthening the tax authorities' assessment powers. So companies with investments in Mexico should review the Mexican federal tax code modification for compliance in the current environment and under the increasingly strict procedure rules and intensifying penalties.
Alrighty, thank you so much, Victor. Very nice question. We actually have a lot, really interesting. So let's have this one. This next one is, digital service providers have the possibility to obtain VAT refunds? Go ahead, Renata. This one's for you.
I take that one. Yes. Well, the immediate answer would be no. With these new VAT rules, like non-residents are only supposed to collect and pay VAT, but are not entitled to credit VAT in Mexico. Therefore, no favorable balance would be generated and no claim could be filed before the tax authorities.
Okay, very valuable answer. And let's go ahead and move on to another one. Which are the general thoughts related to the proposed tax reform? Do you think we are aligned with the other OECD's countries? Victor, you can go ahead and probably this one's for you.
Let me see. Yes, I can take this. This is also a very good question. So personally, I think that in Mexico, the problem is not the tax mix, which is not very different from or what I see or heard from other OECD countries, but rather the low share of tax revenue in GDP combined with, let's say, unnecessary complexities in the tax design. As a consequence, the key challenge is to increase the potential revenue raising capacity, which has been the starting point of the last, or at least the last two reforms proposals. Yeah.
Definitely. Definitely. Okay. Alrighty, let's move on to another one. When is the service provider going to be relieved from Mexican tax obligations?
That's also a digital economy a question. So when this non-resident that provides digital services uses a platform, an intermediary, which also is another non-Mexican resident, the platform would have the obligation to collect and remit the VAT on behalf of the service provider. So when the platform does that, this first service provider would be relieved of the obligation, but always that intermediary actually collects and remits the VAT on its behalf.
If someone made that question, it would be great too. If you would like to go into detail, just send us everything through the chat and we'll be happy to talk to you later on in private and have this very personalized matter. Alrighty, well, we have a couple of more. Let's see, this one. This is a long one, okay? Let's go. Under the current scenario, due to reduced cash flows, some companies may be researching for additional resources. From a Mexican tax perspective, which are there any relevant differences regarding loans from third parties or related parties, as they could be good options to address any liquidity issues?
So, Alejandra, this is a long one and a very difficult one. So, yes, as we mentioned during this context, many companies are facing cash flow problems due to the COVID. So I guess that the question is focused on which may be the alternatives to face these problems. So first of all, it is important to bear in mind that some interest deduction and tax withholding rules before obtaining a loan need to be considered in order to determine the real cost of borrowing the funds. As we mentioned since a couple of years ago, general anti-avoidance rules have been incorporated in law as other requirements such as think-up, back-to-back rules, which also other limitations on interest deduction that need to be considered. So yeah, I guess that companies will not take a decision based on tax matters rather than financial matters, but they need to be aware about the consequences on taxes.
Great. Great answer, Victor. I know that you probably could have extended on knowing the personalized matter, but we can probably do that later on. So let's go move on. So let's move on to the last question. I also see another long one. So let's go ahead. A donation paid to a nonprofit entity that has lost the authorization at the end of the fiscal year would be deductible. What if the donation was made during the first months of the year?
Okay.
This one's for you, Renata.
Yeah, I talk about authorized donations. So where it's important, if an entity lost authorization to receive tax deductible donation, the payer would not have the right to make such payment deductible. Just let's remember that the income tax is calculated on an annual basis, so it doesn't really matter when the donation is paid. What is irrelevant is that the recipient of that donation has a valid authorization for the whole fiscal year. So if this loses that authorization, the payment would not be deductible for the payer.
Yeah, I agree, and it's quite complicated for those type of companies. Yep.
Exactly. I was a little bit impressed with that answer. Wonderful. Well, I mean, we have reached basically the end of the webinar. So, I mean, I would also like to remind the audience that these were really great questions. Please, if you would like to go into detail in a personalized matter, we'll be happy to contact you directly to your email or have a quick chat over the phone and see how we can help you. Like I said, we reached the end of the webinar. JA Del Rio, helping companies do business in Latin America, appreciates your interests and remains at your service for any further questions on the subject. Please feel free to contact us. I thank you all and have a great day. Thank you.
Thanks, everybody, and we remain at your disposal. Have a nice day.
Bye.